All right, welcome to the Explainer. Today we're going to dive into TD Bank's latest earnings report. And, well, on the surface, things look pretty good. But as you're about to see, the real story is a whole lot more interesting and a lot more complex. So, right off the bat, you've got the CEO, Raymond Chun, painting this really positive picture. He's talking up robust fee and trading income, capping a year of strong performance. It sounds great, right? A clear win. And this is where things get kind of weird. This is the puzzle we need to solve. How on earth can a company's earnings be down 10% and up 22% at the exact same time? It makes no sense, right? Well, it all comes down to how you count the beans, so to speak. And this really lays it all out. It's like a tale of two completely different results. On one side, you've got the official reported number, $3.3 billion. That's a 10% drop. Ouch. But then you look at the other side, the adjusted number, $3.9 billion. That's a 22% jump. Now that's what you want to see. So what gives? Seeing it as a bar chart really drives the point home, doesn't it? Look at that gap between the two. We're talking about a $600 million difference. That's a lot of money. And that gap is the key to this whole story. So let's figure out what's hiding in that space between the bars. Okay, so to solve this whole puzzle, we've got to pull back the curtain and look at something called adjustments. This is where the real story is. So, adjusted earnings. What is that? Basically, it's not an official accounting number. Think of it like this. The bank takes its official reported profit and says, okay, let's take out some unusual one-time stuff to show you how our core day-to-day business is really doing. Now, for an investor, this can be super useful. It might show the business is healthier than it looks, but you absolutely have to ask, okay, so what exactly did you take out? And here they are. These are the big items of note they pulled out this quarter. You've got charges for restructuring the company, basically a big reorganization. Then more costs for restructuring their balance sheet. And on top of that, you see charges from their acquisition of Cowen and even some leftover costs from that First Horizon deal that fell through. You add all this stuff back in and bingo, you're back to that lower reported number. All right, so now that we've cracked the code on the headline numbers, let's go deeper. Let's look under the hood at the bank's actual business engines to see where the money's really being made. First up, Canadian personal and commercial banking. This is TD's bread and butter. And it was a really solid quarter. Net income was up a steady 2%, hitting almost $1.9 billion. That's thanks to record numbers in both loans and deposits. Just a solid, steady performer. Now, let's hop across the border to the U.S. retail division. And wow, check out these numbers. Adjusted net income soared 29% to over $1 billion. That's a huge jump. And a big reason why? Remember those balance sheet restructuring costs we saw earlier? Well, this is the flip side. The changes they made are already starting to pay off and boost income. Okay, next up is wealth management and insurance, and they had a fantastic quarter. Get this, net income more than doubled, hitting almost $700 million. So what happened? Well, it was a perfect storm in a good way. The wealth business had record earnings, and, this is a big one, they had way fewer expensive catastrophe insurance claims than they did last year. And we're not done yet. Let's look at wholesale banking. This is the part of the bank that deals with big corporations and institutions. They didn't just have a good quarter, they had a standout quarter. Record revenue and their adjusted net income, wait for it, shot up an incredible 77% from last year. Just amazing performance there. So you add it all up, and the core businesses look really strong, right? But there's a big but. A major challenge has been hanging over the bank, casting this huge shadow over everything. And that's a very expensive investigation into its U.S. anti-money laundering program, also known as AML. And when I say expensive, I mean staggering. The price tag to make this go away, over $3 billion to settle with the authorities. Just think about that number for a second. That is a massive financial hit, and it's a giant flashing sign that said, okay, we need to make some serious changes, and we need to make them now. So what are they doing about it? Well, they've laid out this really comprehensive, multi-year plan to overhaul their compliance systems. And as you can see from this timeline, this is not a quick fix. This is a long haul. We're talking about a process that involves fixing things, getting them checked and double-checked, and working hand-in-hand with regulators and an independent monitor. And it stretches all the way out to 2027 and even beyond. The good news is they're not just sitting around, they're already making some real progress. Just in the last year, they've rolled out some pretty crucial upgrades. For example, they've got a new transaction monitoring system that uses machine learning. They've enhanced their investigation practices, updated their Know Your Customer policies, and launched new focused training for the people on the front lines. So the wheels are definitely in motion.
Okay, so you've got this year of huge costs and massive changes. What comes next? Well, TD has just launched a whole new corporate strategy. This is their game plan, their blueprint for how they're going to grow and get more profitable from this point forward. And it all boils down to three main ideas, three pillars. Pillar 1, deeper relationships. They want to get closer to their clients, especially digitally. Pillar 2, simpler and faster. Pretty straightforward, right? They want to make everything about banking with them easier and more efficient. And Pillar 3, disciplined execution. This is the nuts and bolts, better governance, keeping a close eye on costs, and being really smart about how they manage their money. And of course, this new strategy comes with some big, ambitious financial goals. They're not just talking a big game, they're putting numbers on it. They're targeting a huge jump in what's called return on equity. That's a key measure of how profitable they are. They want to go from around 13% in a couple years to about 16% by 2029. At the same time, they're promising to keep their capital cushion, their safety net basically, really strong. So no surprise here, the CEO is sounding very confident. He's saying that with this new plan, TD is ready for whatever the economy can throw at them, and they're ready to deliver for their customers. So what's the big takeaway here? Well, after a really tough, really complex year, TD has put a massive, costly problem in the rearview mirror and laid out this clear, ambitious roadmap for the future. The blueprint looks good. The real question, the one we'll all be watching, is can they actually pull it off? Can they execute this ambitious plan, especially when the global economy is so uncertain? That's the real test.